Hi, good evening, everyone. Welcome to Up India Karega Invest. Today, we are presenting you with a very interesting topic that is momentum index investing. A new concept which is really prevalent across developed markets and picking up rapidly in India. So, that's momentum index investing. And we have a new fund which is being launched, which invests in momentum index by UTI Mutual Fund. So we have Mr. Shravan Kumar Goyal, Vice President and Fund Manager of UTI Mutual Fund, joining us to give us a detailed view on the new scheme, which on this new theme. Okay. So I'm Karthik from Novise Learning Academy. So what I will do is I'll take you through the basic concept of passive funds, their need and the benefits in your portfolio. So let's get on with the presentation. See, generally, whenever you will be looking at investments in equity, we invest with a lot of aspirations. Okay, we start our investment journey with big hopes that it helps in our wealth creation. Our investment portfolio will help in achieve financial goals, gives us great returns. We set all these expectations, right? The question is, what can go wrong in these expectations? Okay, normally what we do is we create a portfolio of mutual fund schemes. We create that basket and then we invest in them. We pin our hopes that the basket of these funds should start performing really well. So what can go wrong? I'm just showing you two very interesting examples of our flexi cap funds. Okay, and the large cap funds. Flexi cap funds, the earlier name is multi cap. Now we have renamed as flexi cap funds. If you see if you put all the flexi cap funds which is available for us, investable universe, how that they have performed over different time periods. Okay, if you look at 6 months performance or 1 year performance or up to 10-year performance, there is a very big gap between best performing fund versus worst performing fund. Okay, suppose if you look at 10-year period, the best performing fund would have given a CAGR of 15%, whereas the worst performing fund would have given 9%. So there is a good 6% gap which is between the best and the worst, whereas the category average is about 13%. So what I'm just trying to tell you is, all of us would be happy if your fund is average or above average performing fund. I'm sure you would be delighted if it is best performing fund. The question is, what if we end up in one of the worst performing funds? Okay, what could be the impact? Let's look at the similar example. What would have happened in the large cap fund universe as well? If you again look at 5-year or 10-year horizon, the best performing fund would have given 16% return, and whereas worst performing fund would have given 8% return. Look at the impact on the erosion. In the end value, by the end of 10 years, the difference between the best and the worst performing fund would have almost been close to 51%. Okay, had you invested 1 lakh rupees today, if you've been part of the first category, that is which gave you 16% return, at the end of 10 years, you would have got 4.4 lakhs. Whereas in the worst performing fund at 8% per annum, the same 1 lakh rupees would have given you 2.15 lakhs. That is a big challenge. What could happen to us? So the question is, what could be the solution for this? What strategy can we adopt to avoid this kind of risk is what we really need to look at. I think the answer lies in passive funds. Okay. So what is passive fund is what we will discuss today. So passive fund is nothing but you as a fund manager, there is no like I say, active fund management involved. You see an index, say for example Nifty 50 or Sensex, you replicate the same index. Like say if I'm launching a Nifty 50 index fund, the same 50 stocks would be there in the portfolio and same weightage as those 50 stocks. The sectoral weightage, stock weightage, everything would be replicated. So that is what is, like I said, we call it as passive fund, especially in the index fund space. Now, what could be the advantage of having passive funds in the portfolio? Okay, along with maybe say one large cap fund or maybe 2 large cap funds, adding a passive index funds would really add value to you because it helps in diversification. Okay. So the advantage is it reduces the risk. How does it reduce the risk? You may not end up in it being the worst performing fund. At the same time, you may not be the best performing fund as well. You would always be in line with the market. Okay, that is one of the biggest advantage. The volatility factor would be very less when you invest in passive fund investing. Okay, and the biggest advantage of passive funds would be the expense ratio. So when you look at the active funds, the expense ratio could range anywhere from 1% to 2.5%. That could be the very big range what you have with respect to active funds. But whereas passive funds, if you look at the expense ratio, it is 0.05% to maximum 0.5%. Most of the funds are in 0.1%, 0.2% kind of range of expenses. Even this 1.5% expenses, what you are saving, could really add up to the overall performance of the passive fund. So in your core portfolio, having passive fund will really help in reducing the risk. So that is one of the biggest advantage you can have. Okay. So essentially what we are trying to say, along with actively managed funds, it makes sense for an investor, especially considering the current market dynamics and scenario, to have some exposure towards passive funds. Okay. Now, is it just the regular index funds what we have, like Nifty index fund or Sensex index fund? Is it only these? Because when you really look at the performance of these indices, like when you look at Nifty performance or the performance of Sensex, there is one very interesting factor which comes out is, all of you would have experienced in 2018, 2019 specifically, markets are going up, but your fund portfolio is not really moving as much as as what market has done, right? Why does that happen? So the very interesting reason is, I'm sure some of you would already know, when markets are moving, it's only those few stocks which are actually supporting the market rally. Okay. Look at 2018-19, you would have heard of these stocks, right? Hrithik stocks or Salman stocks. That is typically the HDFCs, Reliance Industries of the world, which really pushed the performance of the stocks. But some sectors like maybe pharma or automobile sector did not do well in 2018-19 times. Which means it's only the narrow set of stocks which actually performs well. Even if you look at pre-COVID or post-COVID recovery, the stock recovery, I'm not talking about economic recovery. It is the, like let's say pharma stocks which helped in the market recovery. If you look at US markets, it is FANG stocks, the tech five stocks, that is Facebook, Apple, Amazon, Netflix, and Google, Alphabet. These stocks which really helped in the recovery of the market. Rest all other stocks are actually were lagging behind. So there are two theories to this. Now, one, you could just be part of the index where you can get that some kind of nominal growth, or you can try to identify those stocks within the index and then be part of that focused portfolio. Such portfolio can be called as smart beta. So essentially, there could be a spin-off from the regular index passive strategy of fund management to a smart beta fund management strategy. Let's just look at what is a smart beta. So smart beta, again, is just a concept where you're saying, okay, there are 50 stocks in Nifty, or Nifty 200 might have 200 stocks. Out of these 200 stocks or 50 stocks, you are carving out and selecting few set of stocks into your portfolio. So there could be different strategy. There could be value strategy where you say that I'll pick up only those companies or stocks which are undervalued in relation to market and to its peer group. That could be one strategy. The other strategy could be I will pick up only those stocks or the companies whose debt level is very less. That could be another factor. Or another factor could be momentum strategy. So there could be broadly 4 or 5 different strategies which are available to select stocks separately out of that particular index. So of such one strategy, what we will be discussing today is momentum strategy. Okay. So what is momentum strategy and what is momentum investing? I will just cover only the basics part of it, but the other advanced level of concepts, we would have Mr. Shravan Kumar, covering these. So what is momentum strategy? See, generally when you see, it is some of those stocks which actually is carrying the market. The momentum strategy believes in that one very interesting and simple concept, that whatever has happened in the recent past, okay, is expected to continue in the near future. We are not saying completely long term. We are saying whatever has happened in the recent past is expected to, like let's say, continue in the near future. The whole idea is be part of those stocks where, like, which is performing very well. Buy high, no problem, but sell higher. That's the whole idea. But essentially, please understand, this would be relatively an aggressive strategy compared to the regular index investing. This is an example what I'm showing you on the screen, the MSCI Momentum Index composition. If you see the regular 10 stocks which are there part of the parent index as well of MSCI, in the parent index, that is in the original index, it has only about close to 28% weightage. But whereas in Momentum Index, these 10 stocks, like let's say, comprises of 73% weightage. So which would essentially mean that out of the universe of, say, 100 stocks available, I have selected these 10 stocks and I'm giving almost 73% weightage to these 10 stocks, compared to in the original index, which has only 28% weightage. So your momentum stock portfolio would be a concentrated portfolio compared to a general index. Okay. So when we look at momentum investing in India, National Stock Exchange, NSE, has launched a new index that is called as Nifty 200 Momentum 30 Index, which essentially mean out of top 200 stocks which are available, or out of the Nifty 200 indices, NSE or Nifty has their own parameter to select these top 30 stocks which are which qualify as momentum stocks, and then they create an index. So how they create this index? It's basically they have some internal normalized momentum score. That's what they call it as. Based on that score, that is the last 6 months performance, these 30 stocks are selected and the portfolio is created. But remember, essentially, these are all, when we say top 200, it is combination of large and mid cap companies. So rank number 1 to 100 is large cap, 101 to 250 is mid cap. So, but here we are going only till rank 200. So essentially, this is a combination of large and mid cap stocks. But out of these large and mid cap stocks, 30 momentum oriented stocks would be selected into the portfolio. So this is a momentum index. So the fund what we have being to offer is an index fund which invests into the same 30 momentum stocks. The question is, you must be asking this, acha, okay, fine, why should we invest in momentum stocks or momentum as a theme? Nifty has done a back testing right from 2005 till now. If you see the regular Nifty 200 indices performance versus Nifty Momentum 30 performance, Nifty Momentum performance has actually outperformed the underlying the benchmark. Okay, so if you are with the market, if you are with those hot favorites of the market, and then keep changing the portfolio based on what is being changed in the index, then your momentum portfolio is expected to outperform the regular index by a good margin in the long term. So, okay, that is what is expected. So, in a nutshell, what I'm trying to say is active funds are good. They beat the underlying benchmark handsomely. But if you go wrong in active fund investing, then that means there could be that could be one factor because of which your portfolio performance is actually lagging. Which is why essentially you have to really invest, or you should have some exposure to index, which brings down the overall portfolio volatility. Along with investing in index funds, you could also look at adding some of the thematic strategies like momentum index and so on. Okay, so to discuss further on momentum strategy, I would like to invite Mr. Shravan Kumar Goyal to continue from here.
Thank you, Karthik. Allow me a minute to load my presentation. So Karthik has made my job easier because he has broadly covered index investing as well as momentum based investing. Uh, to begin with, index investing. So investment in equities provides long-term growth opportunity to participate in India growth story. And index funds are the simplest and easiest way to invest in equities because index funds you can correlate with where you are investing. So it's easy to understand. If you are investing in Nifty 50 based index funds, you know that you are investing in top 50 companies listed on NSE, which represents about two-thirds of overall market in terms of market capitalization. So just by investing in Nifty based index fund, you are broadly covering about two-thirds of market segment. And since generally uh, the job or objective of an index fund is to broadly replicate or track the benchmark, which means end of the year the returns would be more or less similar to underlying index. So index funds invest in underlying benchmark companies in the same proportion as they're in the benchmark. So no active sector or stock calls are taken by the fund manager. So that's why as an investor, if you are investing in index fund, you are going to achieve more or less similar returns as compared to the benchmark, which that particular strategy or index fund is following. So it's easier to understand. You can correlate. So, for example, if you are investing in Nifty 50 based indices or index funds, you know that your portfolio will broadly move with Nifty. Similarly, if you are investing in Sensex based index funds, you know that your your portfolio will more or less grow will in line with Sensex. Second, there are no biases when you are investing in index funds because index funds are investing in underlying index stocks. So, which means there is no individual biases of particular fund manager. So, there is no subjectivity involved while investing in index funds. So, as Karthik was referring that best performing multi-cap fund has delivered 43% return and worst performing has delivered about 12%. So, which means uh, your outcomes could have been pretty wide, and you don't know which fund will perform well going forward because there are about 400 actively managed equity funds in India, right? And it's very difficult for a layman or first time investor to select or to understand which funds will do well going forward. You are selecting funds based on their prior performance, but you don't know which kind of strategy will perform going forward. Third, index funds are low cost vehicle to invest in equities. So as Karthik was referring that lowest cost fund is available at 0.10% as well. As compared to that, actively managed funds are charging to about 2% expense ratio. So um, generally it is called that money saved is money earned. So if you are investing in index funds, you are straight away saving almost 1.5 to 2% of additional expense ratio as compared to actively managed funds. So index funds are rule based or index funds are based on a certain index and those indices are rule based, right? And they represent a segment of the market. So if you are investing in market cap based indices, so those funds or those indices will represent a segment of the market. So if you are investing in large cap based indices, so your money will go to large cap oriented companies. If you are investing in mid cap oriented companies, your money will go towards mid cap companies. And these indices have well defined rules and regulations. So you can refer their methodology and you know well in advance on what basis these indices are selecting these stocks. So there is no subjectivity involved of index manufacturers while selecting a company. They follow broadly well-defined rule based approach. And index represents a segment of the market, maybe say market cap based or thematic or sector based or that for that matter factor based smart beta strategies, which we are going to discuss in the subsequent slide. And passive funds have seen phenomenal growth in developed markets. So currently, size of passive funds is actually bigger than actively managed funds in US, and it has grown at a rapid pace in last 2 to 3 decades in most of the developed market. Similarly, in India also, it's pretty fast catching up. 5 years back, the size of passive funds industry in India was about 8,000 crore. Now it is almost 2,30,000 crore. So we have seen phenomenal growth in passive funds. It was about 2.35% of equity mutual fund AUM 5 years back, but right now it's almost 22% of equity mutual fund industry. There are a lot of retirement funds, PF trust, as well as retirement funds, which have started investing in equities via ETF and index fund routes, and that has driven growth, massive growth in passive funds AUM in last 5 6 years. So, what are index funds and what are the types of index funds? So, as I was discussing earlier, the objective of passive fund is to replicate or track underlying benchmark without any subjective bias or human bias. Uh, the objective of the fund manager is to replicate the benchmark. And since portfolio is more or less replicated to the benchmark, which means you will generate pretty similar returns as compared to underlying index, subject to tracking error and expense ratio. Now, let me broadly discuss about the types of index funds which are available globally as well as in India. So, first-time investors should start with broad market cap based indices or funds based on these indices. So, these could be large cap, mid cap, small cap, and apart from that, there are thematic and sector based indices as also available. So, for example, recently in last few years, ESG theme is catching up in a big way. And then, so for example, if you're bullish on Indian industry or Indian economy in terms of consumption, then you can invest in consumption based index funds as well. Similarly, uh, the factor based smart beta strategies have grown or become popular globally in last 10 to 15 years. There is phenomenal growth of these factor based smart beta strategies in last few years. So, factor-based smart beta strategies tries to exploit certain performance factors in order to outperform the broad market indices. And these factors are decided based on long period data analysis. There are a lot of research paper written regarding performance of these styles, which are mainly quant based. Uh, uh, so let me broadly discuss the types of smart beta strategies. So it could be based on certain size. Say, let's if small caps perform better, so one can invest in small cap. Then there are various types such as value, quality, low volatility, and momentum, right? So companies are selected based on a particular factor which has performed exceedingly well in the longer run. So we are going to discuss one such strategy today, which is momentum-based strategy, right? Uh, Globally, there are a lot of research paper written regarding efficacy of momentum strategy. Long period data analysis suggests that momentum is one of the best performing smart beta strategy globally. In fact, iShare MSCI US Momentum ETF, which was launched in 2013, so in about 7 to 8 years time, the fund got scaled up to $14 billion, which in rupee term is more than 1 lakh crore, right? And MSCI US Momentum Index has consistently outperformed broad market indices such as S&P 500 in last 5 to 10 years. So, uh, in terms of longer term performance outcomes are also strong globally. In line with that, in India, we have Nifty 200 Momentum 30 Index, right? This particular index selects 30 best performing companies based on previous 6 month and 1 year returns, adjusted for daily price volatility from Nifty 200 companies after applying derivative as a filter. So let me walk you through about the approaches or steps which this particular index is going to follow, right? So universe for selection of momentum strategies Nifty 200 index. So top 200 companies listed on NSE represents the broad universe from which this index is going to select best performing companies. So first, from these 200 companies, derivative filter is applied. So currently there are about 150 odd companies which are part of derivatives. So only companies which are part of derivatives are only eligible for selection in this particular index. Uh, so 30 best performing companies from these derivatives companies are selected based on previous 6 month and 1 year returns adjusted for daily price volatility. Because momentum strategy is based on the hypothesis that recent market trends persist for medium to long duration. And if you are investing in recent winners, and if you are buying recent winners and selling recent losers, then your return outcome could have been far superior as compared to broad market based indices. Momentum works because market participants initially underreacts to information or events impacting stock prices. Investors wait for companies to perform well for some time before they get convinced about the long-term growth outlook of these companies, and then subsequently they start buying these companies. So because of this human behavior, momentum strategy has performed exceedingly well. Similarly, if a company is going through tough time or going through down, in the sense going through downturn, in that case, investors generally, uh, because of risk aversion mindset, they ignore booking losses. So they wait for some time, say 1 year, 2 year, before they realize that this kind of company or this kind of strategy is not going to work for me. So because of this risk aversion mindset also, generally weak performing companies uh, don't fall that much initially. So momentum strategy is trying to exploit this human behavior, and it is found that longer term momentum strategy has done phenomenally well. So just for the sake of repetition, 30 best companies, 30 best performing companies based on previous 6 month and 1 year returns adjusted for daily price volatility are selected from 150 odd derivatives companies within Nifty 200 index. And this particular index is rebalanced on semi-annual basis. So every year in June and December, this particular portfolio is rebalanced. And weighing of a company is combination of size of the company, which is represented by free float market cap, and normalized momentum score. So product of these two are used for weighing a company with a 5% stock cap. Since it's a quant based strategy, so it's very important that portfolio or index is very well diversified. So 5% stock cap is applied at the time of rebalancing. Now let me show you how this index has behaved in terms of sector distribution. So this particular index follows very aggressive sector rotation strategy. So companies are selected from bottom up. 30 best performing companies are selected irrespective of which sector they belong. So there are no sectoral cap or minimum sector exposure which needs to be there for this particular index. So currently about 60% exposure is there towards IT, pharma and consumer goods, which are considered defensive in nature. So these sectors have shown uh, great amount of resilience during tough time because their balance sheet structure or their uh, free cash flow yield or their actually their business fundamentals are pretty strong and sound. So that's why during tough time, these sectors or companies from these sectors actually perform much better as compared to cyclical sectors. Apart from that, 11% exposure is uh, there towards metal sector, which is showing pretty strong momentum in last few months. So this is current structure. So depending upon which style or which sectors are in favor or which sectors are showing leadership position, those sectors are or companies from those sectors are selected, because momentum strategies based on the hypothesis or belief that recent market trends persist for medium term. And generally we have seen that market cycle doesn't change too often. Generally if one segment of the market starts performing, that continues for medium to long term. For example, in previous 6 years, growth style was in favor, and on continuous basis that style was performing exceedingly well. But in last 1 years, value started performing better. So momentum style will adjust to which style is performing better, because it is believed that those trends persist for medium term. So momentum strategy is trying to exploit these trends and to outperform broad market cap based indices. Similarly, on market cap based also, if large caps are showing strong momentum, higher number of large cap oriented companies are selected. And that's why you have seen that in last 3 4 years, large caps were showing strong momentum. So about 75 to 85% exposure was there towards large cap companies. But in 2015 and 16, when mid caps companies were performing very well, at that point in time, about 30 to 40% exposure was there towards mid cap companies as well. Now, let me broadly show you the performance of this particular index vis-a-vis broad market cap based indices. So in this particular slide, we have broken performance into monthly data. So this index has data from 2005. So we have about 15, 16 years data. So in terms of number of months, we have 190 months data. So out of these 190 months, Nifty 200 index has delivered positive returns on monthly basis in 61% of these months, delivering monthly returns during upmarket move of 5.26%. As compared to that, momentum strategy has done slightly better during market up move. So which means that the up capture ratio or vis-a-vis broad market cap indices, momentum strategy is performing slightly better during market uptrend. Generally, it is believed or perceived that momentum strategy works well during market up move, but actually results are contrary to that. Momentum strategy is performing much better during market corrections, and even bull market also have some corrections, right? So remaining 39% of the ones, whenever market is correcting, it is correcting by 4.73%. As compared to that, momentum strategy is falling much lesser, which means during market fall or during market corrections, momentum strategy will perform better as compared to broad market cap based indices. The reason being could be these are very strong, these companies are showing great amount of momentum or strong momentum, and there are people at the sideline, there are people waiting at the sideline to buy these high momentum companies. And whenever they get opportunity to buy these companies, they start buying these companies during market correction. That's why during market correction, this strategy performs better as compared to up market or market during bullish market environment. Although in during bullish market environment also, this strategy is delivering more or less similar returns as compared to broad market cap based indices. Let me broadly highlight longer term outcome or performance of this strategy vis-a-vis broad market cap based indices. So on last 10-year basis, momentum strategy has delivered 18% annualized returns as compared to 11% for Nifty 200 index. And similarly, out of previous 16 years, 13 years on calendar year wise basis, momentum strategy has performed better as compared to Nifty 200 index. So momentum strategy is delivering consistent returns across market cycle. I would like to highlight a couple of risks here because it's also very important to understand in which all market environment momentum strategy may not perform well. So if market, since momentum strategy is based on the hypothesis that market trends persist, which means if a sector starts performing well, that will continue to perform well for next 2 3 years or 5 years. But if market cycles are changing quite frequently, in those market environment, momentum strategy may not perform well because in those times trends are changing pretty fast, and momentum strategy may not be able to capture those trends. Second, momentum strategies uh, quite aggressive and volatile investment style and it may go period of underperformance. Although longer term outcomes are pretty strong, but if your time horizon is pretty small, then you should not look at this kind of strategy because momentum strategy has done well in the longer run, but because of nature of this strategy, it may see period of underperformance as well. Although on 5 year rolling basis, had you invested any time since 2005 for 5 year time horizon, 98% of the time you would have delivered better returns as compared to broad market cap based indices. So one should invest in these kind of strategy slightly from medium to longer term horizon because short term returns could be pretty volatile. Although to guardrail the downturn and to considering that volatile nature of this index, 5% stock cap is applied so that portfolio is very well diversified at the time of rebalancing. At the same time, to maintain the liquidity of the portfolio, derivative filter is applied, which means that companies which are part of derivatives are only considered for selection in this particular index. Generally, price discovery is much superior in derivatives companies because there are a lot of institutional investors who are investing in these derivatives companies. And if a particular investor has negative view about a company, then he can take naked short position as well. So because of this nature, we believe that from medium to longer term, for some part of allocation may be made in these kind of strategies for long-term wealth creation. Thank you. So I'll stop here and take any questions, suggestion, or feedback that you may have.
Um, Thank you, Mr. Shravan. It was a very nice and detailed view on momentum index. I think got a fresh perspective to this theme. We have a couple of questions which is actually coming our way. It would be nice if you can help us answering those. So you've already mentioned this one point, but it would be nice if you can reiterate this. What is the rebalancing period for this momentum index?
So rebalancing frequencies semi-annual basis. So every year in June and December, this particular index is rebalanced.
So it is done at NSE level, which would be rebalanced by the fund subsequently.
Yes.
Right? I mean, would there be any lag with respect to that?
No, since if you're going to invest in index fund based on this particular index, then there won't be any lag, because index funds objective is to broadly replicate the index. So whenever index is changing, on the very same day, index funds generally follow or replicate the index or change the allocation towards those companies.
Okay, sure. Thank you. Let me take the next question. Some of the gold funds are not performing. Why is the question? I think one very standard disclaimer statement: mutual fund investments are subject to market risk. I think this statement holds good for all investment categories. If you see gold returns in the last like 6 months period, gold prices have been going down from the peak what it had touched during the early COVID period. Now from there, gold has lost a good amount of gains, whatever we had made. So essentially, if you had invested in gold, I'm sure even your portfolio returns would be negative right now. Next question is to Mr. Shravan. So what duration would you would you recommend for this kind of momentum investing strategy? When you say long term, how long is long term for momentum strategy?
So generally, if you are investing in equity-oriented funds for any fund that matter, you should have slightly medium to longer time horizon. So at least 3 to 5 years time horizon should be there for investment in any equity funds, and this holds true for momentum-based strategy as well.
Okay.
On 5-year rolling basis, momentum strategy has performed really very well. So based on previous 15 years, 98% of the times it has delivered better returns than broad market cap based indices on 5-year rolling basis. So ideally, your time horizon should be at least 3 to 5 years.
But it's not like, suppose if I'm investing in Nifty 200 index, if my horizon is 5 years, because this is momentum strategy, I should hold slightly longer than 5 years. No such theory to be applied.
So 5-year rolling performance are showing that 5 year is a decent time horizon to invest in this kind of strategy. But if you are holding it even longer, then it would work even better for you.
Okay, sure. Thank you. Next couple of questions is again directed to you, Mr. Shravan. So let me continue asking. What kind of tracking error can we expect from here? Now, I'm really happy to see the kind of questions. We have a very learned audience here today. So from the regular index, what kind of tracking error can we expect from this fund?
So let me broadly discuss what tracking error is. So tracking error shows the deviation from the deviation of the portfolio return vis-a-vis benchmark return on daily basis. So standard deviation of daily return differential from portfolio vis-a-vis benchmark. So that captures the tracking error. So if portfolio is able to replicate the index on daily basis very closely, in that case, those funds will have lower tracking error, right? And since this particular index is having derivatives as a filter, generally derivatives companies are much more liquid as compared to non-derivative companies. So because of that, I believe the tracking error of the funds which are going to follow this particular index is going to be very competitive, although it may be slightly higher than Nifty based indices, because in those indices, Nifty 50 based indices, because Nifty 50 based indices have lower churn. So only as compared to 5 to 10% churn for Nifty 50 index, this index is going to have much higher churn of about 80 to 100% on an annualized basis.
Okay. So let's take one more very basic question. One of the viewer wants to know, what is the difference between index funds and ETFs?
Right. So index funds are just like any other mutual fund schemes. Only difference being index funds follow a particular index, right? So this is a broad difference between active funds and index fund. Now let me discuss this difference between index fund and ETF. So ETFs are exchange traded funds wherein you can buy or sell those ETFs from the exchanges, BSE and NSE exchanges. So only major difference is ETFs can be bought during the day. So you can buy ETFs during and get the intraday price volatility or price movement as well. For example, today market was very volatile, and if you wanted to capture a particular point of the market, you could have invested at that point in time. So investment in ETF is more or less similar to buying shares, while buying index fund is more or less similar to buying any other mutual fund scheme.
But I'm
Although
sure.
although both are following the from fund manager point of view and from returns perspective, both are going to be very similar, because objective of ETF and index fund from portfolio manager perspective is to replicate the index. Its only difference is how you are buying. If you are buying index fund, you will get end of the day NAV. But if you are buying ETF, you can take advantage of intraday price movement as well. So that's the only difference I would say.
So if I'm really looking at from a 10-year horizon point of view or a 5-year horizon point of view, I'm sure it will not make a significant difference if I were to bought it in the middle of the day or towards the end of the day, NAV, right?
Right. It would hardly make any difference. So if an investor is primarily investing in stocks, and if he is having demat and trading account, he can invest via ETF route. If he is investing in normally mutual fund schemes and comfortable investing in mutual fund schemes, he can take index fund route. Although from longer term time horizon, return differential would be pretty minimal, because both ETF and index funds are having more or less similar expense ratio. And from portfolio side also, it is going to be pretty similar. It only difference is how you are investing, whether you are investing using a demat account or investing via mutual fund. So that's the broad difference.
So, but what could be the difference between the expense ratio, index funds and ETFs? Do you think there could be an impact there?
Hardly any, hardly any. So lowest Nifty based ETF is available at 5 to 10 basis point, and index funds are also more or less available at those expense ratio.
So essentially, then even from the expense ratio point of view, also there's not much of a difference.
Not much of difference, hardly any difference.
Okay, fantastic. So let me take the next question. Would lump sum investments during market dips would help in addition to SIPs? I think it's a great strategy. You see a market correction like this, and if you see a sustainable correction like this, it's great time to be in the market. Let's put a very simple logic. Every time market goes down, it's time for us to buy. There are a lot of funds also which follows the same strategy. They have triggers. Every time market goes down by certain percentage, exposure towards equity gets increased, or when markets goes up, exposure to equity goes down. So there are a lot of actively managed or quant based funds which follow the same strategy. But I think as investor, you can keep simple concept that every time market goes down, it's an opportunity for you to buy. If you have money, I think you should keep adding. Don't focus only on SIPs. So next question is towards you, Mr. Shravan. So what is the expected expense ratio, and will there be any exit load in the new fund what you're launching right now?
So expense ratio for regular plan is about 90 basis point, and for direct plan it is going to be about 40 to 45 basis point, which is 0.4 to 0.45% for direct plan. Okay. And there won't be any exit load for this particular plan.
Okay, not 6 months, 1 year, no such thing. I can put in the money now. I can withdraw.
Yes.
Very nice. Okay. Great. So another very interesting question. We have two different momentum indices available for us, right? Or rather three. But if you look at MSCI Momentum Index or Nifty 230 Momentum Index, what do you think could be the difference between these two? How different do you think these two indices could be?
So as you are referring to MSCI Momentum Index, it's much more concentrated, because referring to your slide, the top stock weight was about 12%. and top 10 stock was about having about 73% weight.
70%.
But in case of Nifty 200 Momentum 30 Index, it is much more diversified because stocks are kept at 5%. So none of the stock will have more than 5% weight at the time of rebalancing. So it is much more diversified, and there is a derivatives filter also, so that the liquidity of the portfolio or index can be maintained. And at the time of churning and at the time of rebalancing, the impact cost can also be minimized. So that's the broad difference between these two indices.
Okay.
Although from globally, so MSCI US Momentum Index and Nifty 200 Momentum 30 Index are more or less similar from portfolio or index construction point of view. Both are using previous 6 month and 1 year price return adjusted for daily price volatility. Both the indices are rebalanced on semi-annual basis, and both the indices are having 5% stock cap, right? Only major difference is Nifty 200 Momentum 30 Index is having derivatives as a filter, because in Indian context, it's very important to have such filter so that the tracking error of the index or portfolio can be minimized. So I was comparing uh, Nifty 200 Momentum 30 Index vis-a-vis US Momentum Index.
Okay. But whereas, MSCI top 10 stocks contributes to 73% of the portfolio. So that is way too concentrated as a portfolio. So now, since we are having that exposure to those 30 momentum stocks, and the general anticipation is that it is expected to perform better than the underlying index, how much return can we expect from momentum index? So I know that is one thing. It's not something approved by compliance for you to really give a certain expectation, but if you're allowed, what could be the difference between the regular indices, investments versus momentum?
There are a lot of research paper published globally about the efficacy of momentum strategy. And based on long period data analysis, it was shown or it was observed that momentum strategy has done phenomenally well from longer term perspective. So let me quote a few numbers here. So previous 5 and 10 year basis, MSCI US Momentum Index has outperformed broad market indices in US by 3 to 4 percentage point on annualized basis in last 5 and 10 years, which is pretty big achievement in US, given that that's a pretty developed market and alpha generation is very difficult there. Uh, uh, I was referring to performance of Nifty 200 Momentum 30 Index. So backtesting data suggests that previous 10 years, it would have delivered 18% annualized returns as compared to 11% for Nifty 200 Index. And 13 out of previous 16 years, it has outperformed broad market cap based indices. So past performance suggesting that momentum strategy has worked pretty well in the past. But one should not invest in these kind of style or strategies from short-term horizon, because if market cycle change quite frequently, in those markets, this strategy may not perform well.
So you did mention this. The strategy works very well even in the down market as well. I mean, I think that's a good perspective, because in general we always associate momentum with the bullish market. It's very rare that one would even look at that. Momentum probably could work in the downside of the market as well. Yeah, I think that's a good point to be really pondered on. You did mention these points, but there's one more question again on how do you really identify these momentum stocks?
So momentum strategy is based on the premise that recent market trends persist. So it's basically trend investing. What has worked in the past may work in future as well. So top 30 stocks based on previous 6 month and 1 year returns adjusted for daily price volatility are selected. And we have found that based on previous data, the long momentum or strong momentum stocks have outperformed weak momentum stocks in the subsequent period. So it's based on the premise that recent performer will continue to perform well going forward also, because if a company's product are getting acceptance in the marketplace, generally we have seen that the acceptance continues for some time or medium to long term. It's not that one product started gaining popularity among people and next 6 months or 1 year down the line, the trend will again change and people will look at some other products. So this style is trying to exploit persistency factor, that recent market trends will continue in the medium to long term.
Oh, great. Thank you. So the next question is, I think one of the viewer wants to know that momentum is definitely one indices one should really look at. Can you suggest probably two more indices one should look at investing, considering the current market dynamics?
So I believe first time investors should consider starting their investment from simple to understand broad market cap based indices. So such as Nifty, Sensex or Nifty Next 50, these kind of indices. Once they understand the nuance of equity investing, then they can start investing in slightly evolved strategy such as momentum. Or if they are investing in these kind of smart beta strategies, they should allocate smaller portion of their overall wealth in these kind of strategy. And once you review or see the performance on live basis, then later stage you can review your exposure in these kind of strategy. Okay. So I would not advocate putting all your money in very aggressive smart beta kind of strategies.
Okay. So you're saying a new investor should start with a conservative note, be part of the large cap portfolios and in the index, or say maybe the multi cap portfolios, and then subsequently make an addition to this.
More part of your portfolio should be in large cap oriented companies initially, and then gradually you can invest in other strategies.
Okay, fantastic. So I think there's very interesting question. It's a continuation to what you've just answered, sir. So there's a very interesting question which says, I've already invested in Nifty index fund. Why should I invest in momentum strategy index? I think you've answered most of it, but no harm in reiterating.
So let me broadly discuss from index construction here. So Nifty represents top 50 companies in terms of size. The top 50 companies based on free float market cap companies. So these are top 50 companies listed on NSE, right? So the selection, the only selection criteria is size. If it is among top 50 companies, then it will be selected in Nifty. While in case of momentum-based strategy, companies are selected based on their recent performance, irrespective of size of the company. So that's the broad difference between these two indices.
So I'm sure we can say that it's a combination of large and mid cap. So this fund could be compared to a large and mid cap fund. Can this be compared to the?
Yes. So this strategy will broadly follow dynamic multi-cap approach, right? Why I would say that? Because if large caps are in favor, 80% exposure could be in large cap companies. If mid cap companies are showing strong momentum, 30-40% exposure could be there towards mid cap oriented companies. Because out of 150 odd derivatives companies, 85-90 companies are large cap oriented and remaining 60-65 companies are mid cap oriented. Okay. So you are going to get flavor of large cap and mid cap, and depending upon which style is doing better, higher allocation will be towards that segment of the market.
Sure. So let me ask two questions, but they are kind of related. So keeping all the factors, what we just heard from you, would you recommend this fund to be part of a core portfolio? Suppose if I'm an existing investor, I have a couple of funds already in my portfolio, say large, multi and mid cap, so on. Would you recommend this fund to be part of core portfolio or satellite portfolio? That is one.
I would say you should start with small allocation and understand the nuance of this strategy gradually, and then at later stage you can review your allocation once you fully understand the strategy.
Okay, so step it up is what you're recommending.
Gradually you should step it up rather than investing large chunk at one go.
Oh, fantastic. So then there is a continuation question to this. So then SIP or lump sum, what strategy you think is what I should follow?
So I would say you should follow your asset allocation, because asset allocation plays pretty big role in overall long-term wealth creation journey, right? Yeah. So depending upon your risk profile, your ability to take risk, you should always follow asset allocation approach. And depending upon where markets are trading in terms of valuations, so valuation should be the guiding principle for either increasing allocation or reducing equity allocation, right? And SIP is always considered as better approach as compared to lump sum investment, because you are getting benefit of rupee cost averaging. And whenever markets trades at attractive valuation, at that point in time, you can top it up by additional lump sum investment. But you should always continue your SIP for long-term wealth creation.
So I'm sure the combination of these two is a better strategy. Like have your SIPs running, you see some kind of opportunities like this, and then probably keep putting.
So if you are investing through SIP, that inculcates habit of saving, right? Because automatically that money will go out from your bank account to a particular fund.
Sure.
So that will inculcate the behavior of savings. So which is pretty important from long-term wealth creation, because unless you are saving, you can't grow your wealth.
Yeah, that's true. So thank you very much, Shravan. So really got to learn a very interesting concept today. I think it's definitely one thought process I think all investors should really ponder on. We wish all, you good luck with the NFO. So thanks for being part of today's session. So thanks everyone for attending. Please leave your comments on the comment section. So thank you. Have a great weekend ahead.
Thank you, Karthik. Thank you, Grow, for organizing this. Thank you.